Is silver getting nuked? George Gammon says so, but why?
We've distilled George Gammon's plus Robert Gottlieb's and David Wu's analyses down to actionable insights.
Get the insights you need in minutes, not hours. First, George Gammon breaks down exactly why he thinks silver is getting crushed.
Plus, we'll look at why economist David Wu believes Bitcoin is finished. All this and more. Just a quick reminder, this content is for educational purposes only and not investment advice.
Alright, today we're diving into George Gammon's recent take on the silver market. Buckle up, because he's got some strong opinions.
George Gammon, the rebel capitalist himself, is always worth listening to, even if you don't always agree. He pulls no punches.
Wait, Gammon? Isn't he the guy who's always talking about escaping the system?
That's him. He sees the silver market as a key indicator of bigger economic trends.
We will be looking at what George has to say about the dollar milkshake theory, interest rates, and industrial demand. How these factors influence the price of silver.
Dollar milkshake? Sounds delicious, but I'm guessing it's not about ice cream.
It's a theory about how the dollar sucks up global capital. Gammon thinks it has major implications for silver.
So it is like a milkshake that sucks up the flavor from everything around it. George Gammon says silver is getting nuked. Strong words. What's driving his bearish outlook?
George believes that a confluence of factors, including rising interest rates and a stronger dollar, are creating headwinds for silver.
Wait, so silver's getting hammered because the dollar's doing well? That seems backwards.
That's the milkshake theory in action. A strong dollar pulls investment away from commodities like silver.
George highlights that the dollar's strength is not just affecting silver, it's impacting commodities across the board.
So it's a broad trend, not just specific to silver's fundamentals.
Correct. The dollar's gravitational pull is making it tough for many commodities to gain traction.
So if the dollar keeps climbing, it's going to keep crushing commodities.
George points out that while industrial demand for silver remains robust, it's not enough to counteract the negative pressures from currency and interest rates.
So even if factories need silver, it won't matter if the dollar's too strong.
That's George's argument. Demand can only do so much when macroeconomic forces are aligned against you.
Kind of like swimming upstream. You might be strong, but the current will wear you down. George discusses that as interest rates rise, the opportunity cost of holding non-yielding assets like silver increases. Explain that.
Sure, when rates are low, holding silver isn't so bad. But as rates climb, you're missing out on potential returns from bonds or savings accounts.
So basically, I'm losing money by not having my money somewhere else.
Exactly, and that makes silver less attractive to investors.
So it's less valuable as other investments yield more.
I get it, makes sense.
George emphasizes that higher interest rates tend to strengthen the dollar, adding further downward pressure on silver prices.
So higher rates are a double whammy for silver.
Precisely, higher opportunity cost and a stronger dollar working against it.
Like a boxer getting hit with a left and a right.
Okay, this is not looking good for the silver bugs.
Not in the short term at least, according to George Gammon's analysis.
George suggests that a significant weakening of the dollar could provide some relief for silver. How likely is that?
Well, George would say it depends on the Fed's actions. If they pivot and start cutting rates, the dollar could weaken.
So silver's fate is tied to what the Fed does?
Largely, yes. A weaker dollar would make silver more attractive to overseas buyers and investors.
It's all connected.
George also notes that a major economic crisis could trigger safe haven demand for silver, potentially boosting prices.
So silver could go up if the economy crashes?
It's a possibility. Silver has historically acted as a safe haven during times of uncertainty.
But you need a crisis to make that happen.
I guess that's the catch. You have to hope things get worse.
George advises keeping a close eye on the dollar index, DXY. A rising DXY is generally negative for silver.
The DXY is like a barometer for silver. Watch it closely for clues about silver's next move.
So if the DXY is up, I should probably be cautious about silver.
According to George Gammon, yes. It's a key indicator to watch.
George also highlights the importance of watching for any signals that the Federal Reserve might be considering a change of course on interest rates.
A Fed pivot could weaken the dollar and provide some support to silver prices.
So if the Fed hints at cutting rates, it might be time to buy silver.
That's one interpretation. George Gammon would probably agree that it's a signal to consider.
It is all about watching for macroeconomic signals. Today, we're breaking down the silver market's wild ride with Robert Gottlieb, an expert in precious metals.
Robert brings years of experience trading and analyzing silver, so he's seen these crashes before. Maybe not this dramatic, though.
Wait, so silver actually collapsed? I thought it was just sitting there being shiny.
Apparently not. Robert Gottlieb's got the inside scoop on what triggered this meltdown.
Robert's providing a forensic autopsy of the market action, pinpointing the exact triggers.
A forensic autopsy? So like CSI Silver?
Exactly. Except instead of finding fingerprints, Robert's uncovering hidden market forces.
Let's dive into his key insights, starting with the big picture.
Robert Gottlieb's analysis reveals a perfect storm of factors that hammered the silver market.
Yeah, from technical breakdowns to unexpected news events, silver got hit from all sides.
So it wasn't just one thing that made silver tank?
Nope, a combination of factors created the meltdown.
We're talking about a 10.5% collapse.
I walked away for 5 minutes. How did I miss this?
Robert emphasizes how many investors missed critical warning signs before the crash.
He points out key levels that in hindsight should have triggered alarm bells, but everyone was too bullish.
So people were just blindly buying silver without looking at the risks.
Pretty much, FOMO is a powerful drug, plus silver is shiny.
Robert's insights highlight the need for more risk management.
Risk management, got it. We'll put that on my to-do list.
And what about the broader impact? Did this silver crash affect other precious metals?
Robert notes that the silver rout sent ripples through the entire sector, spooking investors and triggering more selling.
So if silver sneezes, gold catches a cold?
Something like that. These markets are all interconnected.
Are we talking about a 10.5% drop in gold too?
Oh, thank God. I can take another 10% drop.
Robert Gottlieb points out that silver broke through critical support levels, which then triggered a cascade of stop-loss orders.
Exactly. As soon as silver dipped below that key level, everyone rushed to sell, making the crash even worse.
Wait, so it's like a self-fulfilling prophecy? Everyone expects it to drop, so they sell, which makes it drop?
Bingo. Technical analysis can be a powerful force, especially in a volatile market.
Is that level still in place, or did it reset from the drop?
I need to write this down for future reference. Thanks.
Robert also emphasizes that silver had several failed breakout attempts leading up to the crash. That was a red flag.
So, the market was trying to go up, but couldn't. What does that even mean?
It means there wasn't enough buying pressure to sustain the rally. That's a sign of underlying weakness.
Was this something that traders were watching out for?
Underlying weakness. Failed breakouts. I am way out of my depth here.
So what's next for silver? Is it time to buy the dip or run for the hills?
Robert suggests a short-term rebound is possible, but he advises caution. The market's still fragile.
A dead cat bounce, you mean?
Exactly. Don't get caught thinking it's safe just because it bounced a little.
So we're talking about a possible jump, not a full recovery.
I'm already cautious, so tell me what would make it less fragile.
And what about the longer-term picture for silver?
Robert emphasizes that silver's long-term outlook depends on industrial demand and investor sentiment.
So if factories start using more silver and people start buying it again, it'll go back up.
Precisely. But both those factors are uncertain right now.
Sentiment is pretty shaken right now, so any confidence will need some great news.
Uncertainty. I like the sounds of volatility.
Robert advises all precious metals investors to review their risk management strategies.
Yep, this crash is a stark reminder that even safe haven assets can be volatile.
So what? Set stop losses, diversify, hide under my bed?
All of the above, but seriously, know your risk tolerance and don't overexpose yourself to any one asset.
Robert also stresses the importance of watching key technical levels for potential entry and exit points.
Don't just buy or sell based on gut feeling. Use charts and indicators to inform your decisions.
Okay, so less trust me bro and more show me the data.
Exactly. Robert's analysis points towards the importance of fact-based trading.
I'm gonna need a data for dummies book, I think.
Today we're breaking down some strong market warnings from economist David Wu, Davo.
David Wu, who has a reputation for bold calls, is sounding the alarm about a deadly combination facing stocks.
Deadly combination? Sounds ominous. What's he seeing?
We'll get into the specifics, but Wu is pretty bearish right now.
Wu's analysis covers everything from Bitcoin, BP coin, to the S&P 500. He's not mincing words.
So he's bearish on everything? That's cheerful.
Not exactly, but Wu definitely sees some serious headwinds.
Let's dive into his key points, starting with why he thinks Bitcoin is finished.
David Wu argues that rising bond yields are the key threat to both stocks and crypto.
Yeah, as yields go up, riskier assets like stocks become less attractive.
Wait, why is that? I don't get the connection.
Basically, if you can get a decent return from safe bonds, why bother with volatile stocks or Bitcoin?
So it's all about the risk-reward ratio.
Okay, I kinda see it. Like, why gamble when you can play it safe?
And Wu believes the Federal Reserve's Federal Reserve actions are making the situation worse.
He thinks their rate hikes are too aggressive and could trigger a recession.
So the Fed is damned if they do, and damned if they don't.
Pretty much. They're trying to fight inflation, but they risk crashing the economy.
A classic lose-lose situation.
Great, just what we needed.
Wu also points to geopolitical tensions as another major headwind.
He's concerned about the ongoing war in Ukraine and rising tensions in Asia.
So basically, the world is a mess, and the markets are reflecting that.
Unfortunately, yes. Uncertainty is never good for investors.
So, what does this mean for individual investors?
Time to panic.
David Wu is particularly bearish on Bitcoin, even going so far as to say it's finished.
He believes increasing regulatory scrutiny will stifle its growth.
Wow, harsh. Finished? Is he saying it's going to zero?
He's not saying it's going to disappear overnight, but he sees limited upside potential.
So it's more like Bitcoin has peaked?
Okay, that's still pretty brutal if you're a Bitcoin coin holder.
Wu also argues that rising interest rates make speculative assets like Bitcoin less attractive.
Makes sense. If you can get a decent return in a savings account, why risk it on crypto?
Exactly. It's all about opportunity cost.
So basically, Bitcoin is losing its luster.
Ouch. That's got a sting for the Bitcoin bulls.
And the regulatory environment isn't helping either.
David Wu is forecasting further declines in the stock market. How far does he see it falling?
He's not giving specific numbers, but he believes the downside risk is significant.
Great. So what am I supposed to do with my investments?
He suggests a defensive approach, focusing on less volatile assets.
Time to hide in cash?
Or maybe just invest in canned goods and bottled water.
So, where does Wu see opportunity in this environment?
He recommends value stocks and dividend-paying companies, which tend to be more resilient during downturns.
So boring, stable companies are the way to go.
Exactly. It's not about getting rich quick, it's about protecting your capital.
Safe and steady wins the race, eh?
Okay, fine. I guess I'll buy some utility stocks.
David Wu suggests reducing exposure to high-growth tech stocks, which are particularly vulnerable to rising rates.
Basically, take some profits and rotate into safer assets.
So sell my Apple and Google stock. That feels sacrilegious.
It's not about selling everything, just rebalancing your portfolio.
Diversify.
Okay, fine, I'll consider it.
Wu emphasizes the importance of monitoring bond yields as a key market signal.
If yields continue to rise, expect more volatility in stocks and crypto.
So how do I even track bond yields? Is there an app for that?
Your brokerage platform probably has a chart. Just look for the 10-year treasury yield.
And if it's going up, batten down the hatches.
Got it. Watch the bonds. Prepare for the storm.
Today, we're diving into the mind of Mike Ivry, the head of financial markets research at Rabobank.
Michael's known for his unconventional views and ability to connect global events to financial markets.
Wait, Rabobank, are they like legit?
Legit enough. They handle billions in assets and have a global reach.
Exactly. So when Michael talks, people listen. Michael Ivry sees a massive shift ahead and connects changes in geopolitics to your portfolio.
And according to Michael, we're already seeing the early signs of a global reset.
A reset? Like, what do we have to start the whole game over?
Potentially. Buckle up, because Michael's take is not for the faint of heart.
Michael Every is making a pretty bold statement right off the bat. According to him, globalization has failed.
Yep, Michael sees the writing on the wall, claiming that this era of interconnectedness is coming to an end.
Wait, globalization is failing. What does that even mean for me and my prime deliveries?
It means potentially higher prices, less access to certain goods, and a shift in global power dynamics.
So much for those cheap t-shirts from overseas.
My wardrobe.
Michael Every is connecting geopolitical shifts with the day-to-day of financial markets. How does he see these playing out?
Michael's thesis is that increasing global tensions, trade wars, and political instability will be the primary drivers of the market's performance in the near future.
So, like less about interest rates and more about who's mad at who.
Exactly. According to Michael, global stability is no longer a given, and that uncertainty will be priced into assets.
So fear is the new normal, huh?
Sounds about right for 2024.
One of Michael's key arguments is that the era of Pax Americana is over. What does he mean by that?
Michael believes that the US is no longer the undisputed global leader, and the rise of other powers is challenging the established order.
Wait, so America's losing its mojo? Like we're not number one anymore?
That's Michael's argument. And that power vacuum creates uncertainty and instability.
So, who's stepping up to take the lead?
My money's on Canada, eh?
According to Michael, emerging markets are gaining influence. Where are these power shifts most apparent?
Michael points to the growing economic and political clout of countries like China, India, and Brazil as evidence of a multipolar world order.
So like the whole world's getting a seat at the table?
Pretty much, it is a global table after all.
But are we ready to share the pizza?
As long as everyone gets enough toppings, I'm good.
Michael suggests that investors diversify globally. How can this help to mitigate risk?
Michael argues that by spreading investments across different countries and asset classes, you reduce your exposure to any single event or region.
Wait, so don't put all my eggs in one basket. Got it.
Yep. Diversification is like having multiple life rafts if one boat sinks.
A watery analogy for a watery market, I see.
Someone get me a towel.
What does Michael think about alternative assets like commodities and real estate in the current climate?
Michael points out that commodities and real estate can act as a hedge against inflation and currency debasement, providing some stability in uncertain times.
Wait, so gold bars and a plot of land are back in style?
Potentially. But do your homework before you sink your savings into hard assets.
I always knew my Beanie Baby collection would pay off someday.
Good luck with that.
Michael stresses the importance of staying informed on geopolitical developments. What specific events should we be watching?
Michael advises paying close attention to political elections, trade negotiations, and international conflicts, as these can have immediate effects on the markets.
So, put down TikTok and pick up The Economist, huh?
Essentially, yeah, it's time to become a global news junkie.
Easier said than done.
Fate.
Finally, Michael recommends reassessing your risk tolerance and adjusting your portfolio accordingly. What steps can we take to prepare?
Michael suggests stress testing your investments against various scenarios and working with a financial advisor to ensure your portfolio aligns with your long-term goals.
Wait, so basically, figure out how much pain I can take and plan accordingly.
Exactly. And remember, it's not about timing the market, but time in the market.
As my fortune cookie always tells me.
Can I have your cookie after?
Today, we're diving into Jeff Snyder's analysis of the recent plunge in home sales.
Jeff's been tracking the housing market for years, and this latest data is raising some serious red flags.
Wait, so are we talking like, should I panic sell my house red flags?
Well, let's see what Jeff has to say before we start packing boxes. This video was from Eurodollar University.
Jeff focuses on the underlying trends and what they could mean for the broader economy.
Okay, so it's not just about whether I can afford a new place, but if the whole economy is tanking.
Potentially yes, but remember, context is key. Let's break down Jeff's key points.
Exactly. Let's get into the nitty-gritty of home sales numbers.
Jeff Snyder's main point is that home sales are plummeting to levels we haven't seen since 2010.
Yep, we're talking about a significant drop, which could signal broader economic troubles.
Wait, 2010? Wasn't that right after the financial crisis?
Exactly, so this is definitely a cause for concern.
So if people aren't buying houses, that means what exactly?
That we're all going to be living in cardboard boxes.
Jeff emphasizes that rising mortgage rates are a key factor in this slowdown.
As rates go up, fewer people can afford to buy, which chills demand.
Okay, so higher rates mean I'm paying more each month. Got it.
Exactly, it's basic economics.
Basic and painful for anyone trying to buy a house right now.
So I should just keep renting forever?
And why should we care about home sales anyway?
Jeff points out that the housing market is a crucial indicator of the overall economic health. When housing slows down, it often signals trouble ahead.
So it's like the canary in the coal mine for the economy.
Pretty much, it's an early warning sign.
Canaries are cute though. A housing market crash, not so much.
I am definitely more worried about the crash.
Jeff notes that while inventory is increasing, prices aren't dropping as much as you'd expect.
Yeah, there's more supply, but sellers are still trying to get top dollar. It's a standoff.
So, there are more houses available, but they're still too expensive for normal people.
Pretty much, the market's stuck in a weird place.
Like that awkward moment when no one wants to dance at the party.
I think I'd rather dance alone than buy a house at these prices.
Jeff also points out that builders are becoming more cautious, slowing down new construction.
They're worried about getting stuck with unsold homes if demand keeps falling.
So, they're building fewer houses because they're not sure if people will buy them.
Exactly, it's a risk management move.
But wouldn't building more houses help bring the prices down?
That's too logical of a thought. Just stop it.
Jeff predicts that if mortgage rates stay high, we'll likely see further declines in home sales.
Higher rates will continue to put pressure on affordability and cool down buyer enthusiasm.
So basically, no relief in sight for potential homebuyers.
Not unless rates come down significantly.
So it's all about watching what the Federal Reserve does.
If only we had a crystal ball.
Jeff warns that if the housing market remains weak, it could contribute to a broader economic slowdown.
A struggling housing market can impact everything from construction jobs to consumer spending.
So a housing slump could drag down the whole economy.
Potentially, yes, it's a significant risk.
It's like a domino effect, right?
More like a demolition derby, and my wallet's in the front seat.
Jeff suggests keeping a close eye on mortgage rates and housing market data to gauge future trends.
Staying informed can help you make better financial decisions, whether you're buying, selling, or investing.
Okay, so I need to become a housing market expert overnight?
Not necessarily, but paying attention to the key indicators can give you an edge.
Or at least help you avoid making a really bad decision.
I'm really good at making those.
Jeff also emphasizes the importance of considering the broader economic implications of what's happening in the housing market.
Housing trends can impact everything from interest rates to inflation.
So it's not just about houses, but how the housing market connects to the rest of the economy.
Exactly, everything is connected.
Kinda like that time you tried to build a house of cards.
The difference being the house of cards falling didn't impact the global financial system. Mostly.
Wow, what an exhilarating conversation today, packed with insights.
Absolutely. Jeff Snyder, Michael Every, David Wu, Robert Gottlieb, and George Gammon each brought such diverse perspectives.
Right? It's fascinating how they all agree on the struggles facing the housing market and globalization.
But the real point of contention came down to the specifics, like Jeff's views on housing recovery compared to David's.
And let's not forget Michael's concerns about globalization, which were met with skepticism regarding their long-term impact.
Exactly. Their discussions emphasized how interconnected these issues are, creating a tapestry of potential outcomes for investors.
So, if you found value in these insights today, make sure to give us a thumbs up, subscribe, and share this video.
Your support is crucial for us to keep bringing you these deep dives into critical financial topics.
Stay tuned for our next episode, where we'll continue to unpack what these shifts could mean for your investments.
Don't miss it. We'll be here to guide you through it all.